Welcome to a video by Sebold Capital Management. In today's video, we're going to talk a little bit about how to choose a financial advisor from a perspective of understanding what rules advisors are regulated by. Because there are two specific rules that advisors are regulated under, and it does have an impact on what those advisors can and cannot do. So let's start. We'll go to this SEC website and we'll look at the big ones. There are two general rules, the 33-34 rules and the 40 Act rules. So these are the laws that govern all the people in the securities business. So let me take you on a little bit of trip down history lane here. So in 1929, we had a very large stock market crash, October of 1929, and a lot of people were wiped out. We've heard stories of people jumping off buildings and it was awful. And some of the problems was there wasn't a lot of rules associated for publicly traded companies. So the government did a really good thing. They spent a good amount of time. So from 1929 to 1933, over 4 years before they got this law into effect. So the Securities and Exchange Act of 1933 were the rules and regulations on how to start a publicly traded company, how much capital you had to have, how much disclosure you had to have. So all these rules on setting up a publicly traded company. So we needed that rule. The second rule here was the Securities Exchange Act of 1934. We needed rules around the people that were selling shares of these companies. There were no rules. You just went down to Wall Street, why it's called Wall Street, and sold shares, under the tree there. My grandfather was one of those people. So they didn't have to be regulated or licensed. So with the Securities and Exchange Act of 1934, that was the rule that said you have to be licensed in order to sell publicly traded companies. So 33 and 34, sometimes they're referred to as a 33-34 Act advisor or a broker. So prior to 1999, they weren't allowed to be called advisors. They had to be called brokers or registered representatives. These two acts are all in the business of selling products for a commission, selling stocks for a commission, selling bonds for a commission, mutual funds, limited partner shares. It was all about selling an investment product for a commission. You also might have heard of something called a wirehouse broker. Well, these actually started because wirehouses, when people were buying and selling bonds to fund the wars, that's where they got their funds from. So they would call people and they would wire in the money. So these were, again, generally referred to as wirehouse brokers. Okay. The second act is the 1940 Act advisors. So you see the Investment Company Act and the Investment Advisors Act. The Investment Company Act is all about creating an investment company. You probably know this in the form of a mutual fund. A mutual fund is an investment company. Sometimes they're referred to as a 1940 Act fund or a 40 Act fund. This is where that comes from. So they're open-ended mutual funds. You can put money in, you can take money out. Their job is to manage your money. The difference in the 40 Act advisors versus the 33-34 is the 40 Act advisors are a fiduciary to their clients. They are required by law in the 40 Act to do what's in the best interest of the customer. Okay. The Investment Advisors Act of 1940 is just someone who manages money on behalf of a customer. So their job is, again, to do what's in the best interest of the customer by law. That's a 40 Act advisor. Where things got muddled and why it's a little crazy today is back in 1999, there was a firm called Merrill Lynch who was seeing a lot of their brokers leave the brokerage industry and go to start up their own 1940 Act firm because they wanted to manage money. They didn't want to sell products for a commission because it didn't matter if you sold products for a commission, whether your account went up or down. It only mattered how much you could generate in commissions in that account. There were rules against churning, which was the phrase, which was I'm just buying and selling securities just to generate commissions. So a lot of good people wanted to leave that format. So Merrill didn't want to lose all their advisors. So they went to the Securities and Exchange Commission and they said, guys, we want to charge a fee on our accounts. Is that okay? And of course, they were 33 and 34 Act advisors. So they weren't providing any continuous management to this. So the Securities and Exchange Act Securities and Exchange Commission didn't know what to do. So after, and I'm certainly not party to those discussions, but what happened eventually was they said, you go ahead and do that and we'll get back to you. And this was in 1999. And this was referred to as the Merrill Lynch rule. So when we pull this up, the Merrill Lynch rule, so this was a 1999 action by the SEC, exempting brokers from using fee-based accounts for regulations governing financial advisor. Because in the past, you couldn't provide investment advice unless it was solely incidental to a product sale. So this drastically changed the industry in terms of what advisors could and could not do. That's where things get a little bit muddled. Now, again, prior to that, these advisors couldn't be called advisors. They had to be called brokers or registered representatives. So after 2007 is when this law, when the actual law got put into effect. 1999, they made their decision to say, yeah, you go ahead and do it. They didn't really disclose what they were doing until 2007 after the Financial Planning Association sued the SEC and they came to an agreement as to what happened there. So that's the big distinguishing characteristic between a 3334 Act advisor and a 1940 Act advisor. So a 33 Act advisor is somebody that sells products for commissions. A 40 Act advisor is an advisor that manages money. Where things get a little bit muddled today is there are some 3334 Act advisors who also act as a 40. Again, makes things a little bit more muddled from a compensation perspective. So be wary of that. So those are the big rules and regulations with regards to financial advisors. 3334 for brokerage firms, 1940 for registered investment advisory firms. There's a last one that I'm not really going to talk about, but that's trust companies. Those are actually regulated by the states and some federal regulations. So if you have a trust company managing money for you, it's a little bit different. But those are generally the ones that are most important. Keep an eye out for more videos with regards to how to choose a financial advisor and some of the rules and regulations around this so you can make the best decision for you, your family, and the things that you need to do moving forward. Thanks for watching.